Hello and welcome to another episode of Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about the state of ESG data and its use and misuse with Bruce Kahn, PhD of MSCI. Bruce gives technical advice to investors on MSCI's climate solutions tools and data sets for investment decision-making, risk management, reporting, and engagement. Prior to this role, he worked in climate change research, portfolio management, and wealth management at Citibank, Deutsche Bank, Macquarie, and others. Now, Bruce has a wide range of other activities. He is a trustee and chair of the finance committee of the Robert and Patricia Switzer Foundation, and he is adjunct professor at Columbia University's Earth Institute. Bruce earned his PhD in land resources from University of Wisconsin and served as an agricultural extension agent in the United States Peace Corps in the Republic of Cameroon. So, Bruce, thank you for being here.
Well, thank you, Rob. I appreciate it.
So I was wondering if you could start for our listeners with where you think the state of the ESG industry is today with managing the quality of the data, the clarity of it, et cetera.
Yeah, the data has come a long way, but let me take a little bit of a step back and distinguish between what we mean when we say ESG data. Environmental, social, and governance data are data that are collected from review and analysis of the performance of individual companies on a variety of metrics, such as environmental management, whether they have, how rigorous their environmental management system is, some of their governance policies, frameworks, and programs, that seek out an evaluation of how well the company is being managed, and also the S being social issues, which could include employees, but also stakeholders that are external to the firm, but may have an important role in the firm's success. So how a company performs on these variety of metrics is what the E, S, and G data are. They are performance metrics on these terms. So while I say this is what they are, I also want to say what they are not, right? They are not values-based assessments, like is this good or bad, or is this moral or amoral, right? It is just a rigorous evaluation of performance. So what has happened in my experience, over the past 20 years in this industry is we morphed out of the kind of what is a responsible company. Does it have philanthropy? Is it doing good things for its customers and stakeholders and communities where it works? But it is evolved into more of an analytical framework, as I just described. And what has also evolved is the idea of impact investing, which is, hey, I want to make sure that there are more jobs in a certain region of the world, or improved air quality in a certain region of the world, right? Those impact metrics are a separate set of data that have evolved, and those can be more of a good, bad, assessment of, depending on, what the proclivity of the evaluator is looking at. Mm-hmm. And so why I sandwich ESG in between SRI and impact is because ESG evolved to be really strictly a performance measurement system on the environmental performance of a company, not the environmental impact of a company, the environmental performance of a company, the social performance of the company, and then the governance performance of the company. Then what we do with that data has also evolved. So it started as negative screening. Oh, these companies have this exposure, so this is a bad thing, so I want to divest from that company, all the way to, oh, this company is deploying renewable energy, so I want to get into that company, right? Or in some way. And those, I'm sandwiching again those two sides from ESG. ESG simply takes the information, and what people do with it is to use that information to then put the financial condition of the company in context. How do these factors such as E, S, and G, how do these performance metrics, how are they reflected in financial statements? What do I expect from the company from these performance metrics, and then I can bake that into my financial modeling. And that, in my opinion, those are three distinct categories. There's the data and its use of a screen, if you will. There's the data and its use of what is the impact. But then in the middle there's the data and the integration of ESG with financial considerations to understand how well companies are performing.
Great. You said something very important there that I'd just like to rewind to. You made a distinction between performance and impact.
Yes.
Could you delve into that, what that means a little bit more? Because I think it's real important for the listeners of this podcast to understand that.
So when we evaluate a company's environmental performance, let's say on climate, is it reducing its emissions, right? So as an E metric, I'm going to be looking at its emissions and how much it has cost the company to reduce those emissions, right? So that is the metric. What's the return on invested capital for this emissions reduction project? Okay. Mm-hmm. That is separate and distinct from saying, this company is reducing its emissions, because it is deploying it into renewable energy. And so by deploying money into the renewable energy industry, I'm creating, quote, an impact in the world, which is moving the world from fossil fuel-based reliance into a more diversified energy reliance, such as including renewables. And that has a positive impact on the environment. But when I evaluate the return on invested capital of the project to the company, I'm not really taking into consideration necessarily the overall movement of the energy system to renewable energy or the impact that might have on a reduction of deforestation. That's not part of my calculation. My calculation is I'm looking at the return on invested capital of this project that is going to reduce emissions. Now, in the abstract, emissions do not yet have a cost, right? In some markets, there are compliance markets in Europe, but in the United States, for example, we do not have a regulatory carbon price. So emissions, reduction is fully voluntary. But if I can generate a return on that invested capital as a steward of capital, as a CFO of a company, then that is a net NPV positive project, then I'm going to consider that. And that is, in my mind, and what I think the industry still struggles with, is putting ESG into financial context and outside and distinct from the kind of values context of, is it a good company or a bad company, or is it positive impact or negative impact? And impact and good or bad are kind of beauties in the eye of the beholder. ESG is not a beauties in the eye of the beholder assessment. It is evaluating company performance on well-established metrics and looking at how does this affect my expectations of the firm's cash-generating potential.
Yeah, the eye of the beholder is something I think gets left out of this a lot. I'm really glad you said that, because if you think about the difference in the regulation for carbon between here in the United States, in Canada, and in the EU, which is the scope of many asset owners' full range of investments, those are very different things. So this kind of leads me to another question about that I think is sort of interesting now. Do you think it's useful to break out the E, S, and the G, or is there some type of conflagration going on here?
Well, at the end of the day, really, ES, it can be seen as a subset of G. In terms of the metrics we use to measure and manage E, S, and G, we do this separately. But truly, a well-governed company is going to be governing its environmental performance and its social performance as part of G. So I do think it is worthwhile to remain having like these E pillars, S pillars, and G pillars as separate and distinct measurement and evaluation criteria. And then when we roll up to an overall ESG score, you're losing information because your positive S value may be offsetting some of your negative E value. It's the same when you think about climate risk. A company will have exposure to climatic disruption into its physical assets and those costs, but then those costs may be offset by the way that a company is positioned to gain profitability from a low carbon economy. So, when you just give it an overall risk score, you're kind of missing the interstitials, if you will. And for analysts and PMs, those interstitials, those devils in the details is what makes and breaks an analyst's job in being accurate at uncovering a company, or a PM's job in delivering their fiduciary duty.
Well, let's have that part of that conversation, because, of course, a lot of the people who dial into this podcast are analysts and portfolio managers. So what do you think they should do and not do with those interstitials?
Well, what I think what I think they do, and what I have been doing my career, is looking, bottoms up at the activities of a company and going activity by activity and determining whether it's a good deployment of capital on the part of the management of the company. Are they improving their environmental performance, and is there a return on that invested capital, right? And then rolling that up, project by project, location by location, right? But to get a better sense of the company. Now, some of that may be painstaking, and that is the job of an analyst. It's painstaking to go through all that exercise, but it is an important exercise to really understand the company. And what I think that analysts should do with ESG data information is use it as a context builder for the other information they're looking at about a company and discussing. So with management. So it is not simply a substitute for anything, but nor is it a grade that you can just stamp on an analyst report. We firmly believe that while this information can be used in a quantitative manner, as like a grade, if you will, but also it is primarily at its core fundamental bottoms-up information about company performance, and so analysts need to use that in concert. Use the ESG information in concert with the other financial analysis it's doing. The thing, Rob, that strikes me about the whole conversation is that when we're talking about a company and we're saying, well, here's the financial statements and here's the business of the company, and then here's this report over here, the ESG data about the company, and it appears to be that they are something separate and distinct. And I'm positing that and it's not just me, like lots of people in the industry have been doing this, is that any information about the company is material to the financial analysis of the company. Now, it may not have a huge dollar value, so it might not be financially material, but any information about a company is information about a company. So you should be using the ESG data in concert with the other information that you're looking at when evaluating a company, whether it's equity or credit. And then finally, as an individual who has to be evaluated by their peers, we've moved into like the 360-degree, review. I want my boss to review me. I want people who work for me to review me. I want my peers to review me, my customers, et cetera. Same with a company. All ESG does is gives you another view from a different perspective of how the company is operating. And that should be taken into consideration in concert with your financial analysis.
Okay, well, let's put the rubber on the road for a second here. One of the subsectors that I think is really interesting to look at with an ESG frame are the oil majors. Because we have one group of oil majors who are not really doing much for the future of their companies. They're just drilling more at a higher price. Other oil majors are spending some of what they're making right now to improve their company's probable performance well down the road. So an analyst would look at this and say, from a very basic perspective, the former group has better cash flow. So we should rate them higher than the other one who has greater expenditures. How do you think that is going to work out basically in the ESG future?
Well, it is the tyranny of the quarterly earnings treadmill that we're on, which is I need to deliver returns this quarter. And having been a PM that lived and died by quarterly return in terms of winning and not winning mandates or losing mandates, that is what is the measurement stick. So I think every individual case is different. The deployment of capital into new projects is going to have an IRR, and each company has their own threshold for IRR metric for doing a project or not. And the other context here is that the energy sector is evolving and changing, but it doesn't mean that the firms that are involved in these sectors will not pivot and as well. So understanding the full picture of a company's performance on current, this quarter's, generation of cash versus what it's investing in the future, and that's going to be up to the analyst. So I think that as to how they're going to value add, but doing the exercise is what is critical. It doesn't just mean, oh, it's an oil company, you have to screen it out, or oh, it's a solar company, you have to screen it in. Mm-hmm. No, you have to look at the company's operations, how well they're operating, where they're operating, and then what is the policy and regulatory context of that jurisdiction to determine whether those companies are going to still be able to march on as they are, or whether they're going to need to evolve. What I think we've seen over the past, since I've been in the industry about 20 years, is that it has evolved. And those who are not looking ahead into new and diverse sources of energy are having trouble, not only from gaining new leases and being in line with regulations, but being in line with investors. Now, we're not suggesting, I don't think the industry is suggesting that the corporate management of any oil and gas major or any company delegate its strategic business decision-making to the investor community. But they certainly are aware of investors' demands really for lower and lower emissions from our economy, carbon emissions from our economy. So investors are putting that pressure on corporate management, and corporate management is responding, but it doesn't delegate the responsibility of the corporate to the investors. I think that's the key issue here.
Right. Well said. So last question I'd like to ask you, because you have been in this long enough to remember and have worked on SRI, when that's what we called it. And you sit in a very rare spot that you have a lot of vision towards how investors are working with this type of data. As you look at the ESG data industry, what do you think that the industry should do over the next couple of years to improve the quality of the data, the usage of it, et cetera?
Well, when it comes to some of the main kind of ESG data, we have really good data collection systems now. But I will say that we are also beholden to corporate transparency. So we collect a lot of alternative information that's not what's disclosed by a company. We collect a lot of alternative information about from the internet, from other databases out there.
Okay, could you give us an example of that?
Sure. So like we look at, for example, in EPA in the U.S., EPA data, the Environmental Protection Agency data on toxic release inventories and other databases that they release, and that is at the zip code level. So you can drill in and figure out which companies are doing what and where. And that is getting better and better. But but there are elements that we still rely on corporate disclosures for, and that's also an important area. So what we expect to see is more pressure on companies to be more transparent. Carbon emissions is a really great example. So we do understand scope 1 and scope 2 carbon emissions of firms, right? Which is the direct emissions of a company, scope 1, and scope 2 is the indirect emissions, where the company buys its electricity and what the mix of the fuel source is of that electricity that generates that electricity. But we also recognize that a huge proportion of global carbon emissions comes from a firm's scope 3 emissions, the indirect emissions upstream and downstream from a firm. And more transparency into firms' supply chains is going to help us get better at measuring, monitoring, and hopefully managing the scope 3 emissions. So that level of transparency is really critical. And then, very often you find, financial firms whose climate risk is largely tied up in their loan book, right? The book they have, the loans that they're making or the mortgages that they're providing. The climate risks sit there, but the industry has very little transparency into what that is. And so, what I think we'll see more innovation in and more evolution is that we will get more and more data released by firms, and not because they're going to be regulated to do it, but because it's in their own interest. So in their own interest to really get down to the granular level of their entire supply chain, their entire book of business.
Mm-hmm. Well, there is a regulatory map for that, is there not, in KYC?
Yes, there is, and there's also a lot of accounting tests that firms have to do when regulators come, but that data still is largely private. So there's that innovation, and I'm bringing up the private side too, is because we are now seeing really a move. So SRI and ESG, really started with public equity. It moved into public bonds. We are now really, really breaching the walls into the private asset world, and so we're going to see a lot more data coming out of the private world, the private equity, private debt, infrastructure, natural resources, parts of the market where. In real estate, where there's just a tremendous amount of investor dollars at work. We're gonna see more transparency, at least on the ESG and climate front.
Well, here's to hoping. Maybe we should end on a positive note like that. So, well, thank you, Bruce, for talking with us about this. Your insight into it is extremely valuable, and I hope we can have you back to talk about what some of those scope 3 things are as they evolve.
Excellent. Thank you, Rob, and thanks to the CFA Society.